Well, the topic that's most on people's minds at the moment is the financial system inquiry that David Murray is chairing. There's a couple of things that have come out of that very long interim report that I think are going to be most important to financial advisors. Number one on that list is residential property. It's a significant concern to the government and to the panel that residential property probably presents one of the most significant systemic risks to the Australian financial system. When you look at residential property, it does attract virtually all of the concessions that you can imagine. Firstly, for banks who are lending money, they have a lower charge for the capital that they direct to residential lending versus other areas. So they have an automatic predisposition to direct money to residential housing first and foremost. Interest rates are at never-seen levels, historical lows, both officially and through the bank lenders. Residential property attracts concessional CGT, as a lot of other assets that you hold for more than 12 months. And a very unique feature that really relates very much to it is negative gearing. And the government has attempted to pull out negative gearing before, back in the mid-80s, for those who remember. Negative gearing was quarantined for any new property purchases. And what we saw was a massive increase in rents in every Australian capital city. And no government's been game to go back to that topic since then. If I had to pick where I think the government may move, it might be on the CGT concessions over the 12-month period, where the 50% deduction may either be taken away or wound back a bit so that they can try and moderate demand a little bit. The other areas that the financial system inquiry is really focusing on is a very important one, life insurance. There is significant underinsurance for people in the Australian market. The problem's been, I think, to some degree, the very sophisticated levels of analysis and efficiency that the life insurance companies bring. Over the years, they've become much better at assessing risk at an individual level and therefore trying to work out when to offer people policies, and if so, at what premiums. Unfortunately, that sophistication means that the people who most need life insurance, those who potentially do have more risk, either don't get offered it or can't afford it. And it will be interesting to see whether the government perhaps adopts some of the measures it uses with, say, health insurance, where people aren't rated individually, but they're rated more at a community or perhaps at an industry level. But that's an area that is definitely going to need some attention. I think also on the government's mind and the panel's mind is the issue of adequacy in retirement. Despite the best efforts of government, and they do put some pretty significant tax concessions in, many Australians still opt for a lump sum and choose to manage, particularly through SMSFs, their own superannuation. They don't get directed towards annuities. And the government recognises there isn't yet products that make that a compelling proposition, but I wonder what taxation and other changes the governments will bring in to try and address that issue. Speaking about adequacy in retirement, financial advice is obviously fundamental as well. The panel, the government, have a very clear view that they want to make sure that affordable quality financial advice is available to all, and finally getting some settlement on the most recent FOFA changes through the Parliament, I think is perhaps firstly giving people a little bit of capacity to begin to think about how to address that need, and secondly does provide the space over time for scaled financial advice to be offered under more specific conditions. And I think in advice, that's the area that's still going to get some attention from the Murray inquiry. Other than that, I think we're seeing financial markets steady. The US is looking very, very healthy at the moment, I think, on every measure, whether it's employment, manufacturing, inflation. Things are looking very positive. And maybe to come back and close just on a point in relation to residential property, official interest rates at 2.5%, we've never seen before in this country. The thing that will cause rates to move is further progress on that global economic recovery. I think we're about 12 months away, but within a year after that, so 2 years from today, I think we'll see official rates back at something closer to 4%. So whether people are thinking about debt, whether people are thinking about where to invest, and particularly residential property, that's something that I think everyone needs to start bearing in mind.